So if you're watching this video, it's because you have some extra money that you want to invest, or you want to start saving money to invest it. And overall, you just want your money to work for you to make you more money. That's where I was a couple of years ago. And in this video, I'll teach you the 5 steps to start investing if you're a complete beginner and if you want your money to turn into hundreds and thousands of dollars like I did. All right, so the first step should be to think about what your goal is with investing. Do you want to invest long-term, short-term? Do you want to invest to potentially buy a house, save for retirement, or buy the car you always wanted? You could also invest just as a way to keep up with inflation so that your money just doesn't sit in a savings account making you little to no money. Your goal can always change and probably will change over time, but just think of a goal for when you start investing. The second step will be to determine how you want your investment to be managed and by who. If you have no knowledge on stocks and investments, I'd recommend booking an appointment with your bank so you can discuss investments and learn more about it. If you want to take a little more of a risky route and you feel like you know what you're doing, you probably don't. But you can use apps like Wealthsimple in Canada or Robinhood in the States to open your first investment account and begin investing in stocks, ETFs, mutual funds, and anything that you choose. Personally, I did both routes. I went to my bank to open my first investment account, and I also later opened up my Wealthsimple account and started investing on my own. But if you're a complete beginner, I definitely recommend going with your bank first. They'll be able to tell you which kind of investment account you should open up first, like a TFSA, a tax-free savings account, or a FHSA, a first home savings account, or an RRSP, a registered retirement savings plan, and the list goes on. I use a TFSA, which is basically an account that you can invest in completely tax-free under certain conditions, which are really not complicated to follow. The main ones are that you have a limit which you can contribute every year. And the second one is, if you're in Canada, you have to invest in Canadian stocks, or else if you have foreign stocks that pay you a dividend, you'll have to pay some taxes. And the last main condition with the TFSA is that you can't day trade. All right, so the third step is to determine what you want to invest in. Earlier, I mentioned ETFs, stocks, mutual funds. Those are just a few of the many different things that you can invest in. There's plenty of YouTube videos that explain what these are in greater details than I would ever. So I would recommend watching those after this video. Also, please do your research and ask a professional to know what's the best investment for you. Personally, I own a couple of individual stocks in companies that I believe will grow. And I also invest in a couple ETFs, which are exchange traded funds, which is a more cost-effective way to have a diversified portfolio with stocks in multiple sectors of the economy, which I will discuss more in step 4. I also invest in dividend stocks, which is basically a stock that pays you a certain amount of money every month or every quarter, that no matter if the price goes up or down, the company pays you to have one of their shares. I see it as a way to make passive income without having to worry about the stock price going up and down. Speaking of diversified portfolio, step 4 would be for you to diversify your portfolio. Don't put all your eggs in one basket. With my years of investing, I found it really important to have different types of stocks in different sectors of the economy. This is a way to be safe if a sector of the economy struggles, and by owning multiple stocks in different sectors, if that sector struggles, it's not gonna have as much of an impact on your portfolio. There's so many categories to choose from for investing, like advertising and marketing, aerospace and defense, automotive, banking, clean energy, crypto, ETFs, finance, technology. The list goes on and on. Diversifying mitigates market volatility, which should lead to some more stable returns over time. Step 5, keep investing no matter what, through the ups and the downs of the market. If there's one thing I regret doing early on in my investing journey, it was stopping to invest completely for a period of 2 years. I was spending my money on useless things and not putting some money aside for my investments, which made me lose a period of 2 years of compound interest and dollar cost averaging. Speaking of, you should know what these two things are. For starters, compound interest is when you earn interest on not only your initial investment, but also on the accumulated interest from the previous period. Let me use an example. If you have $100 worth of stock that earn you a 5% interest every year, that means that at the end of the year, your $100 would have made you $5 extra, so you'll have $105. Now, if you keep that $105 invested and you don't even add more money, after the second year, you'll have earned another 5% of $105 now, which will mean you'll have $110.25 after the second year. So without even having to invest more and more every year, your money is going to be making more and more every year off of the $100 that you initially invested. That's why the earlier you start investing and the longer you invest, the more your money is going to grow like a snowball going down a hill. The second term I mentioned earlier was dollar cost averaging. Dollar cost averaging, on the other hand, is an investment strategy where you invest a fixed amount of money into a specific investment at a regular interval, regardless of the market price at the time. This strategy basically means that you buy more shares of a stock when the price is low and less shares when the price is high, which helps lower your average cost per share over time and reduce the impact of market volatility. So keep investing through the highs and lows, and you're almost guaranteed to make money over time, since in the past 100 years, the market has always gone up, regardless of the drops and the spikes. You're now ready to start investing, and don't try to time it. The best time to start investing is now, the present. So go.